Hello, everyone, and welcome to our second session of Simon Quick Takes. I am Courtney Skinner, Executive Director of Advancement for Simon Business School, and it is my pleasure to introduce Professor Christian Opp. Professor Opp is an Associate Professor of Finance and the Faculty Director of the Simon PhD program. He holds a PhD and MBA from the University of Chicago Booth School of Business. Professor Opp's research analyzes financial institutions and markets' impact on allocations, with a particular focus on the role of informational frictions. Today's session will include 20 minutes of presentation and 10 minutes of audience Q&A. Please utilize the Q&A function to submit a question. Christian, the floor is yours.
All right, thank you very much. I'm delighted to be here and talk about stock prices and whether they're off from fundamental value or not. So this is joint work with colleagues of mine, Jules van Binsbergen, Andrea Tamoni, and Martin Boons. And in this paper, we're addressing something that is, I think, on the minds of many investors when we see these wild swings in stock prices. We saw those already a few years ago, for example, with GameStop and AMC. But the finance literature really has been investigating anomalies, that's what they call them, anomalies for decades. These methods have been successful in doing some things, but not so successful in identifying mispricing. And I'll tell you a little bit more about that in just a moment. So what this finance literature has been doing is it has identified a range of what are called return anomalies. And return anomalies, you know what a return is. You invest today and you get maybe 10, 15% on your investment over the next year. That's a return. Now, what is a return anomaly? A return anomaly is a situation where you systematically identify stocks that generate abnormally high or low expected returns, accounting for their riskiness. Okay, so the idea is that you can get more return on average keeping the risk fixed, or you get less return that on average keeping the risk fixed. And obviously in one case you would want to buy the stocks that generate high abnormal returns, or short the stocks, that is sell the stocks that generate low expected returns, because you want more return as an investor. Now, the literature has been good in identifying stock characteristics that predict these abnormal returns. However, there's a difference between these return anomalies and actually stock over or underpricing. And why that's the case, let's have a look at a little chart here. So we're going to start here with the green line that represents the fundamental value of a stock. And suppose that the market price currently is actually below the fundamental value. So the fundamental value of the stock is here. This would be the correct value. The market price is currently here at the beginning of this chart below fundamental value. So the stock is initially underpriced. Okay. And now when we identify in finance a positive anomaly return, this could be coming from the resolution of mispricing. That is, a stock that was underpriced starts to become more closely aligned with fundamental value. And as you can see here, that would lead to a positive anomaly return. That is not a reward for risk. It's just a correction of mispricing. Okay. So in this case, this anomaly return resolves mispricing. We had mispricing up front, a gap here between the market price and the fundamental value, and this positive anomaly return resolves mispricing. That's what we will call in this paper a resolution return anomaly, because it resolves mispricing. Now, a positive anomaly return can, however, also lead to the buildup of mispricing. So here's another chart where we have the fundamental value as the green line. And now we can have at the beginning of this buildup of this mispricing episode, we have a positive anomaly return again, but this time this anomaly return creates mispricing rather than resolves it. So in and of itself, a positive anomaly return doesn't really tell you whether it leads to the resolution of mispricing or whether it leads to the buildup of mispricing. It also doesn't tell you whether the stock was initially roughly correctly priced or whether it was initially underpriced. And so that is what we're going to bring to the table with a new methodology to really figure out not just where do stocks in the short term go in terms of positive returns, but where are we in terms of the gap relative to fundamental value initially, and do the short run return valuation, short-run returns actually increase mispricing, or do they resolve it? All right, so that's the basic idea. So what we're asking in this paper is specifically which firm characteristics are associated with over and underpricing. I'll tell you a bunch of these characteristics. So it's actually implementable for the typical fund or even for investors, general investors. Then the question is, does the mispricing first get worse before it gets better? That would be build up before it gets resolved. And then we also ask the question, well, do firms actually respond to this mispricing when making their investment decisions? The idea here is that when you go to business school, you learn that you should, as a manager or CFO, aim to maximize the value of the firm. And what managers are doing is they're looking at the stock market and they're trying to figure out, well, what types of projects are being valued by the market and what projects should we take? The issue is that if these market signals, these market prices are distorted, then firms follow the guidance of the market. That is, they invest in high value projects, but these projects maybe are actually not as valuable, or maybe they're missing out on some projects that the market thinks are bad projects, even though they are actually good projects. Okay, so there's a spillover effect of these financial market mispricings to firms' real investment decisions, because managers respond to the market. They pay attention to market prices when making investment decisions. And so we'll have some findings on how that spillover occurs, specifically how the mispricing component of prices spills over into real investment decisions by managers. All right, so what are our main findings? Well, first of all, there are a couple of characteristics that are associated with very significant mispricing, double-digit percentage magnitudes. For example, on the underpriced side, you have the smallest stocks tend to be mispriced or underpriced specifically by about 30% on average. Deep value stocks are those stocks that have trading at low market values relative to their book valuations. They're also underpriced in the 30% range. And the worst, momentum stocks. Momentum stocks are those that have had poor performance in terms of returns over the last 6 months or up to a year. On the overpriced side, we have, on the other hand, large stocks tend to be overpriced, and growth stocks. Growth stocks are the opposite of value stocks. They are those that are currently trading at high prices relative to their book valuations. Then the next finding is that actually a substantial fraction of these return anomalies that have been identified in the literature, they do not lead to the resolution, the correction of mispricing, but rather they lead to the buildup of mispricing. And some prominent examples here are, again, the momentum stocks, that is in particular the stocks that have had the worst recent returns relative to other stocks in the cross-section of stocks in the United States. The worst performers tend to be already underpriced, and the additional momentum returns that push them further down lead to even more underpricing. Similarly, those that have had poor profitability tend to be already underpriced and then exhibit further negative returns that make them even more underpriced. In terms of the magnitudes, these price level distortions affect a substantial fraction of market cap of the aggregate market. So it's not just that small pockets of the market are affected, and we therefore are not too worried about potentially spillover effects to real investment. So for example, if you take 2017 numbers, where we had total market cap in the range of, I think, 27 trillion. When you look at the top 10% of growth stocks, they had a price mispricing or price dislocation of about $1 trillion, which is quite significant in terms of magnitudes. And then going to the issue of how firms are responding to this mispricing. Again, we teach you should maximize the market value of the firm. And if you just pay attention to how the market evaluates these projects, you may choose the wrong investments if the market gets it wrong, if the market assigns the wrong value to projects and firms. And so what we find using these mispricing measures, that about 3 to 5% of firms' real investment decisions appear to be a response to the mispricing component. So there is potentially quite a bit of spillover of these mispricings in financial markets to what firms are actually doing in their capital budgeting decisions. All right, now, when we investigate these various anomalies, we can actually provide some additional guidance as to why these anomalies happen, or what are the origins of these mispricings. One very prominent anomaly in the literature is the return anomaly, the momentum return anomaly. The momentum anomaly is basically saying the following. It says that stocks with the worst returns over the last 6 months, it could be a slightly different window, let's say last 6 months, the worst returns, they keep underperforming in the next 3 to 12 months. Okay, so that's the idea of momentum. You do poorly and you keep doing poorly in the future. That also holds on the upside, by the way. So if you have been doing extremely well relative to other stocks in the last couple of months, then you keep doing well in the next 3 to 12 months. Okay, so that's the idea of momentum, which is an anomaly. So you get more return holding risk fixed. Again, so the risk return trade-off is improved if you expose yourself to momentum. All right, now there are two explanations that are behavioral explanations in the literature that are actually very different explanations for the same return phenomenon. The first explanation is that investors, when they see, for example, bad news, let's say there's a bad earnings announcement, they respond to it. So there's a negative return, but they don't quite incorporate the whole bad news, everything of the bad news. And so what happens is that you get initially some bad return, and then investors figure out, well, it's actually even worse than what we initially read into the news, and the price keeps falling. Okay, so they're not quickly incorporating all the news. They're sort of slowly, if they're first underreacting and then slowly incorporating the full news, that would create momentum. That is the first explanation in the literature for this momentum return. There's another explanation that is actually quite different. The other explanation is that rather than investors underreacting to bad news, they're actually overreacting. So the opposite of it. In this case, you get bad news, they're pushing down the price too far, and then they're extrapolating and pushing down the price even further the months after. Okay, so they get scared and more scared, and prices fall and fall and fall. Okay, so these are two explanations that are quite different, and based on what the literature has documented so far, it doesn't identify really whether these negative momentum returns are due to explanation 1 or explanation 2. That's why there is a debate in the literature. Now, with our method, we can identify the difference between these two. In particular, what we find is that momentum is a buildup anomaly, and since it is a buildup anomaly, it means that there is already underpricing of these poorly performing stocks, and then it gets even exacerbated thereafter. That's the idea of a buildup anomaly, and that is consistent with explanation 1. So we provide some guidance as to what's going on, why these anomalies occur. All right, now another neat feature of our method is that you can go to the firm level and pick a firm, consider its characteristics, such as how much on where it lies on the spectrum in terms of value versus growth. So you can rank firms by their market to book ratios. You can rank firms according to their momentum returns, whether they are high momentum or low momentum. And you can categorize them based on size, etc. And once you feed all this information into our method, you can determine for a specific stock what the price wedge is. The price wedge here is the idea of the price level dislocation. So what you see here is for Apple, an example where we go from 1983 all the way to 2017. And a positive price wedge means that our method says that Apple was overpriced. So we're starting here with roughly 30% overpricing. If we're in negative territory, then the stock is underpriced relative to fundamental value. Okay, so we're starting here just as an example with Apple in the early 90s. Apple actually went into a sort of a negative momentum spiral, which meant that negative returns predicted further negative returns, which pushed the price all the way to about minus 35% underpricing in 1997. Coincidentally, at that time, Steve Jobs becomes the CEO of the company. And thereafter, you start to see actually the resolution of this mispricing. So we're going more toward fundamental value again. We turn into a value firm, which generates higher returns typically, and we start to get positive momentum, which predicts further higher returns. So we go completely in the opposite direction here. We in fact get this momentum overshooting effect. That momentum leads a firm that is already overpriced to be further overpriced. And there's a resolution phase again. And then again, a prolonged momentum period in which Apple was overpriced, according to these results. And finally, we have some resolution of mispricing in the last couple of years here of our data window. Okay, so the nice thing is we can really go to the level of the firm, feed in the information about the firm's characteristics, and then get an output that says how far off is a specific stock price from its fundamental value. Okay. All right. So what are the implications of all this? Well, so there's a range of reasons why these price wedges, these price level dislocations, are interesting for practitioners, but also for researchers. In particular, in the finance literature, there's a big debate about the extent to which financial intermediaries are actually adding value to society through their trading activity. Okay, the idea is that if we have smart money moves investments to firms that are deserving that capital and that have the most productive investments. And so the financial industry, it does something good for society in that regard. Now, the issue is that in practice, we see funds that are trading on these various anomalies. But as we just saw, there are a couple of these anomalies that create the buildup of mispricing. Some create the resolution of mispricing. That is, some make mispricing worse, and some resolve it. And so here we have now guidance on, if you're a policymaker and you're thinking about, well, which of these trading strategies are actually helpful in reducing price dislocations. We have exactly this categorization into buildup versus resolution anomalies, where you say if funds are trading on buildup anomalies, they are actually pushing prices in the wrong direction. By trading, for example, on momentum, you tend to further dislocate prices through your price impact as a fund, relative to the situation where you wouldn't trade. Okay. On the other hand, if you have funds that are trading on value strategies and things like that, they're actually trading in the right direction. They're pushing prices, they're buying stocks that are underpriced and pushing the prices up toward fundamental value, thereby making prices more accurate and thereby creating a positive spillover effect also to the real economy that then makes the investment decisions based on these price signals. So that's the idea. So there's definitely an implication here also for the value of mutual funds and other funds, hedge funds, etc., whether they're actually trading in the right direction or in the wrong direction. It turns out you can make money doing both. You can make money trading a momentum. It's good for the fund maybe, but it's not good for society if you're further dislocating prices in the short term. Now, as you saw, another neat aspect of the method is that we have for practitioners as much as for researchers these firm-specific price dislocations that then allows us to study to what extent does a specific firm respond to that mispricing in its investment policy, etc. And that is, I think, going forward, a big agenda for the finance literature to really study better how these price inefficiencies in financial markets have potentially effects for real investment on the firm side. Having said that, these price level dislocations are obviously also interesting for a regular retail investor that is thinking about whether they should invest in a particular stock or a certain segment of the stock market. And we provide a range of characteristics of firms that you can look out for that tend to predict over or under pricing, which is certainly interesting if you want to think about forming a portfolio, in particular if you have buy and hold portfolios. That is something that is valuable for you to know. All right, so with that, I'm gonna switch over to Q&A. I think I'm roughly on time here with 12:20, and I'm gonna switch over here to the Q&A section. I have to read it a little bit. Now, there's a question about how you define mispricing. I think there are actually two questions that are quite related. And so fundamentally what we're doing is we're doing what you tend to do in your capital budgeting investments lectures, but in a more sophisticated way, which is we are fundamentally pricing these stocks. Okay, so what happens is you have a benchmark asset pricing model, be it the CAPM or more sophisticated models. And then you use that to determine discount rates. And then you look at how these various portfolios that have been documented in the literature to generate abnormal returns, how these portfolios generate cash flows historically, and then you discount the cash flows that these portfolios tend to generate with the appropriate discount rates that account for the true risk of these cash flows. Okay, so in the end, it's a discounted cash flow method in one form or another. There are technically a lot of details that I'm not going to get into here, but if you want to have in broad strokes the idea of it, that's what we do. And so then you do that at the portfolio level where things are quite stable. That is, you have a typical relationship of what are the typical discount rates given the risk that would be appropriate for, let's say, the smallest decile of stocks in the US stock market. You look at what these stocks are generating typically in terms of cash flows and what the appropriate discount rates would be given the riskiness that these stocks have. You take the present value of that and then you effectively compare that to the ongoing market prices. Again, there's a lot more going on, but if you want to know it in broad strokes, that is how it works. All right, then there are, I think, something that is an interesting question regarding where's the overall market going. Okay, so these are obviously also very interesting questions, but they're somewhat distinct to what these return anomalies that I've been talking about are about. So when you try to detect mispricing in the cross-section of stocks, it turns out that you have much more statistical power. Also economically, it's easier to identify mispricing in the cross-section relative to the identifying predictability in returns for the aggregate market. Okay, so the evidence on market timing abilities and the evidence on return predictability for the aggregate market is much weaker. So our method actually takes out those effects and it's really all about the cross-sectional mispricing. That is, at any point in time as an investor, you have a choice of a range of securities in the stock market, and there is some relative mispricing across those. And that's the type of mispricing that these typical return anomalies identify in terms of return mispricing, and we're mapping that into price level deviations. So I can tell you again, in terms of timing the market at the aggregate level, that is something very difficult, number one. Number two, identifying mispricing is another issue there in the sense that it is hard to say that investors should have the same risk appetite at any point in time. That means it may well be that higher returns in the recession are very much, meaning when you reach the bottom of a recession, typically returns going forward tend to be higher because prices are falling a lot. But that may well be a compensation for risk and the risk aversion that people have at that point in time. You can't necessarily term that mispricing at the aggregate level. All right, let me see if there's maybe another question here. Yeah, so there's an interesting question about the increased market presence of passive investment vehicles and to the extent to which that contributes to fundamental price distortions. That is an excellent question. This is actually something that we want to study in further detail and follow-up work. The idea being that there's been a push toward passively managed funds, that is funds that are just tracking indices, etc. They're not taking a particular stance on what companies are particularly good in terms of their fundamentals. And if you have an increasingly large fraction of market participants that are not doing fundamental analysis, but rather just saying, well, we're just tracking the index and we just follow this strategy, that you have fewer and fewer market participants that are actually providing information that embed information into prices. And so there is certainly a concern that the rise of passive investing is potentially causing these price wedges to become larger. There is, so again, I think that's an excellent question. It is something we have not looked into conclusively. In part, that's because these are secular trends that are confounded by many other effects in the data. So it is not an easy task to conclusively identify this, but it's definitely a great question. And I would say economically, it's very plausible that the rise in passive investing has led potentially to price dislocations and get more extreme because fewer people are actually acquiring information and more people are just tracking the market, whatever it does. All right, let me see if there's another question. Yeah, institutional investors, whether they're tempted by momentum trading, it depends on the funds. I mean, there are funds that are very much going into momentum. It's a specialization of certain funds that are know how to implement this strategy well. The idea that it's mainly a retail-driven phenomenon, again, this is to some extent a debate still in the literature. That's something we don't fully answer with our method. What we're saying is momentum seems to be overreaction and extrapolation. Now that overreaction and extrapolation can certainly come from retail investors. It's quite plausible that less sophisticated investors would be more prone to overreaction and extrapolation based on recent performance. That rings very true. And there's certainly evidence that in the literature already that individual investors are more prone to these types of behavioral biases. Now, at the market-wide level, to what extent they account for that, and whether institutional investors are, and whether retail investors are pretty much the only drivers of that is not clear. To some extent, again, the idea is that if institutional investors that are smart money realize that there are some investors that are going to be extrapolating for the next 3 to 12 months, and they're predictably going to do that, then you, as an institutional investor who just cares about making a high return over the next few months, you're saying, well, I'm going to go into this security, into this class of securities, these momentum stocks, before the retail investors keep pushing up the price even further, and then I make an abnormal return, right? The idea is that is a smart thing to do if you just want to get a high return for an institutional investor. At the same time, you are actually pushing prices earlier in the wrong direction because you're basically front running the behavioral investors that are going to keep pushing the prices up and up in the future. And so in that case, even though it's somebody who's very smart, who's trading, an institutional investor, it is actually not really helping with improving price informativeness and the accuracy of price levels. All right, let me see how we're doing on time.
That brings us right up to it, Professor Opp.
Okay.
So I will close us down. Thank you all for your thoughtful questions. And thank you again, Christian, for sharing your research and insights on stock prices with our alumni, students, and community members. We encourage you all to subscribe to the Dean's Quarter blog. You can see the link in the chat. And we hope you'll join us for a future Simon Quick Take session. We will be on hiatus this summer, but look forward to reconvening in the fall. So thank you, everyone. Have a nice summer.